So now today we'll be looking at a published financial statement, and kindly I urge you, don't copy, not unless you want to write just the important point. Though I'll forward everything. Everything will be covering all the short notes and all the solutions for what we'll be covering. So what you can do, what I can allow you, you can just take a screenshot. I'll be giving you 1 minute, 3 seconds to take the screenshot, but I'll send you the whole materials. So, and then this published financial statement, it will be there. It never misses. And then published financial statement. We have some aspect I want us to go through together. And kindly, I just need like 10 minutes. Then I can see some members, they are having problem with audios. So kindly, for those who cannot hear the audio properly, first of all, can you log out? Just log out and then log in. And then you join with audio. Yeah, join using audio. I hope now we're okay. So now let's continue. So what's published financial statement? That's under IS number 1. Now published financial statement, they're just summarized financial statement ready for publication. Summarized financial statement ready for publication. Now those are the reports that you usually see them in the newspapers. That's what we call the published financial statement. And they're actually just a summary, it's just a summary. So in this case, I'll be preparing our financial statement. It's somehow different from how we are preparing others, like how we account for banks, insurance, we have including all the details. So in this case, we try to make it just a summary. And what are those published financial statements? Actually, they are classified into 5. Number 1, we have published, we have consolidated, then we have statement of comprehensive income, then we have statement of financial position, statement of cash flows, then we have a statement of changes in equity, and then we have the notes to the financial statement. Those are the 5 financial statements we have. Statement of comprehensive income, statement of financial position, then we have statement of cash flow, statement of changes in equity, and the notes to the financial statement. Now, let me explain our notes to the financial statement. I'm sure for section 3, normally you have not heard about the notes to the financial statement. Now, whenever you see a financial report, the financial statement, income statement, financial balance sheet, and the statement of changes in equity and cash flow usually carries just or occupy the first or 3 pages. All the other information, that's what we call the notes to the financial statements. So the notes to the financial statement try to incorporate the explanation to the items in the financial statement, such as the compliance, the standard used, some reports. Which are those reports? Auditor's report, director's report, segment reports. Also, we have the PP movement schedule. Also, we have sustainability report, environmental report, integrated report. All the kind of report usually goes to the notes to the financial statements. Now, let's go to what we call the special topics. And those small special topics, kindly you need to get them clearly. You need to get them clearly. Number 1, we have recognition of closing stock. Recognition of closing stock. How do we recognize closing stock? Closing stock is recognized based on the row of number A, either the cost or the net realizable value. I repeat again. How do we recognize closing stock? Closing stock will be recognized based on the row of number 1, the cost, or number 2, the net realizable value. Then number 2, recognition of provisions. Remember, provision is just money set aside. We have what you call provision for doubtful debts. How do we recognize, or how do we recognize provision? Provision, when preparing the published financial statement, only recognize provision if the probability of occurrence is more than 50%. Only probability is more than 50%. If it's less than 50%, don't show it to the financial statement. Take it to the notes of the financial statement. Another thing you need to know, it's all about what we call financial instrument. What are financial instruments? Now, financial instrument is a contract giving rise to an asset to one party and a liability to another party. I repeat again. A financial instrument is a contract giving rise to a financial asset to one party and a financial liability to another party. What do we mean? That means, for example, if I give you a loan of like 10 million, to me, that loan, if I give you a loan, to me, it's an asset, but to you, it's a liability. Now that's what we call a financial instrument. If the company issues shares and you buy the shares, if you buy the share to it becomes an asset, to the company becomes a liability. So now that's what we call financial instrument. So under the two, we have financial asset, financial liability. Now let's focus on financial asset. And what are financial assets? I say that financial assets, they are just financial investment, and they are broadly categorized into four. But I want to look at the two. Number one, we have what we call financial asset at fair value. I'm trying to categorize the financial asset. Majorly there are four, but I want to classify them into two. We have financial asset at fair value. Now, financial asset at fair value, number one, they are short-term financial investment. That means if they are short-term, you take it to the part of current asset. I repeat again, financial asset at fair value, they are short-term investment. Hence, it should be recognized under the current asset. Then they are measured or valued at fair value. And fair value simply means the market value. Fair value is the market value. That's number one. Let's go to number two. We have another financial asset known as available for sale financial asset. Available for sale financial asset. Now, AFS, this one is a long-term investment. Long-term investment. If it's a long-term investment, that means we'll be recognizing it as part of non-current asset. I repeat again. Available for sale, they are long-term investment. Hence, they should be recognized under non-current asset. Then they'll be measured either at cost, or what you call the amortized cost, or at fair value. So you can use the two valuation model, either the cost or the fair value. Now, let me go back again. We have said that we have financial asset at fair value and we have available for sale. Financial asset at fair value, they are short-term. Available for sale, long-term. Financial asset at fair value, they are current asset, but available for sale, they are long-term asset or non-current asset. Another difference is that for financial asset at fair value, they are recognized or measured at fair value. That's the market value. But for available for sale, they will be recognized or measured or valued either at cost or at fair value. Good. Another thing, let's look at what we call deferred tax. Deferred tax. Now, deferred tax, in another term, we have what we call the current tax and we have the deferred tax. So what do you think is the deferred tax? Deferred, or we can say deferred payment. Now, deferred tax is the tax payable in the future. That's what we call deferred tax liability. Deferred tax, tax that you'll pay in the future. Also, sometimes you may overpay your taxes. So that means you have something you recover in the future. That's what we call deferred tax asset. So deferred tax in layman's language just means the tax payable in the future, which arises as a result of what we call temporary difference. What are those temporary differences? Now, the temporary difference are what we call the difference between the carrying amount and the tax base. Now, for those who have done taxation, how you account for profit as an accountant is totally different from how a revenue authority will account. You see, for the tax aspect, we have what we call allowable, disallowable expenses. But for accountants, an expense is an expense, an income is an income. Now, the difference between the two perspectives is what we call the temporary difference. And the temporary difference is what gives rise to deferred tax. Now, this is what I mean. Assuming you have a land that you bought it like 2 years ago at 100 million as a corporation. So that means the tax base is 100. Then at the end of the year, you revalue that asset upward, maybe to 120. The cost was 100, but by the end of the year, it's 120. So that means we have a gain, yangapi, of 20 million. Now remember KRI, they know every gain should be taxed. So this 20, you subject to tax of 30%. So that means 30% of this gain of 20, that's 6. But now remember one thing. Yeah, that's tax of 6. But you have not sold the asset at umepata pesa. So that means that tax will have to be carried forward. So that's what we call deferred tax. You are not paying now, you'll pay in the future. Another thing you need to know that increase in deferred tax liability. Remember, deferred tax is a liability. And usually do what we call provisions. If a deferred provision increases, that one becomes an expense. Like for example, if you're supposed to pay a deferred tax of 20, but next year increase to 30, you can see the movement from 20 to 30. That increase by 10 becomes an expense. You have to pay more. But if deferred tax reduces, that means the reduction in deferred tax that one becomes an income. I repeat again, if deferred tax provision reduces, that one becomes an income. If deferred tax expense increases, that one becomes an expense. So you need to get the two. Having you need to get there. I think with that one we okay. Then another thing we need to look is how to recognition of ordinary shares. Recognition of ordinary share. Now, how do we measure ordinary shares? Now, ordinary shares should be recognized at par value. Ordinary share capital should be recognized at par value with the balance taken to the share premium. This is what I mean. Let's go back to the whiteboard. Go to the whiteboard. Now, this is what I mean. Assuming you had 100 shares and you had bought each at 10 shillings. So that means you have equity worth 1,000. You had 100 shares in a certain company and you bought each of the par value of 10. So that means your worth is 1,000. Now, assuming after 2 years, you still have the same number of shares, 100 shares. But at now, remember the market price usually do keep on changing. But for now, you get that the current price, the market price is 15 shillings. So that means your current net worth equity is 1,500. How do you recognize this one to the financial statement? What do you take to the ordinary share capital? What do you take to the share premium? We have said that to the ordinary share capital, recognize them at par value. That means you'll take 100 shares, the par value, the original, it was 100, it was 10. That means the ordinary share capital, it will be 1,000. Then to the share premium, remember premium is a gain on the share. You have 100 shares, the price has moved from 10 shillings to 5. That means there is a gain of 5. That one you take it to the share premium. However, you multiply by, you have 100 shares and each has gained by 5. So you have 500. So that's how you recognize. To the ordinary share capital, you take 100. To the share premium, you take 500. If you mess, you just take the whole 1,500 to the ordinary share capital. That thing is wrong. So remember, for financial reporting, we need to follow the standards. We have the AS, we have the IFRS. So that's another thing you need to consider, recognition of that. Another thing you need to know is how do we recognize tax expense? Now, the tax expense is made up of 2 components. Number 1, we have what we call the current tax, and then we have what we call deferred tax. So the current tax, you're just taking the current, now the current tax is just tax based on the profit for the year. That's simply, if you made a profit of 10 million, just take 30% of that. That's what we call the current tax. Deferred tax, we have said, is just the movement, tax payable in the future. Tumesema, if a deferred tax increases, that one becomes an expense. Kwa hivyo, you add. That means you have to pay more taxes. If deferred tax reduces, it becomes an income. That means if it reduces, you deduct. You take the current tax minus the provision. That means you'll pay less. So to the tax expense, we have the current tax, we have deferred tax. Another thing you need to consider is that PPE, what we call the plant, property, and equipment, when preparing the published financial statement, PPE should be recognized as a single figure. What do we mean? Assuming you have, assuming you had land, you had plant, you have fixtures, you had fittings, to the balance sheet, you don't show them separately. No, we have said that publish something that is summary. It's just a summary. So if you are doing, you have those other items, you have to go to the workings, work out for PPE. You bring the land, you bring the building, furniture, you put them together, you work out them together. To the balance sheet, you will take them as one figure. So it's another thing you need to note on that. So that means to the statement of financial position, PPE should be recognized as a single figure. So another thing I want you to note, it's all about recognition. What do we take to the income statement? What do we take to the balance sheet? So under the expenses to the income statement, expenses will be classified into 4 classes. Number 1, it's either cost of sale, or it's either an admin expense, or selling and distribution expense or finance or interest expense. I repeat again. To the income statement, expenses will be classified them into 4. It's either cost of sale or admin expenses, selling and distribution, and finance. Now, finance will be dealing with the interest. So, assuming we have depreciation, we have salaries and wages, we have staff costs, there is nothing like that to the state when you're preparing the published financial statement. You have to work those costs separated and you bring them as a summary. It's either cost of sale, admin expenses, selling and distribution, or finance cost. Good. Then another thing you need to note, we have what we call other incomes. We have what we call other comprehensive income. Other incomes, other comprehensive income. What's the difference? Now, other incomes is income which is eligible to be distributed to the shareholders as part of dividend. It's their wealth. But what you take to other comprehensive income definitely will go to the statement of changes in equity as part of reserves. So you need to note that what do we take to the income to other income, what do we take to other comprehensive income? All items valued at fair value. I repeat again. Items valued at fair value, their revaluation changes should be recognized under other incomes. I repeat again. Revaluation changes for the items valued at fair value. Fair value is the market value. Either you may gain or you may lose. Those changes should be taken to other income, either as a revaluation gain or revaluation loss to other incomes. Now, other incomes ni kule juu, just below the gross profit. Number 2, revaluation changes for PPE, that's plant, property, and equipment, and available for sale, AFS, should be reported under other comprehensive income. I repeat again. Revaluation changes for item valued at fair value, that's the market value. Their changes should be reported to other incomes. Then, revaluation changes for PPE and available for sale. Remember, we have said that available for sale, they are long-term investment, therefore they are non-current asset. Their revaluation changes for both available for sale and PPE should be recognized under other comprehensive income. Kule chini. Now, other comprehensive incomes comes immediately after the profit after tax. And what you take to the other comprehensive income will definitely go to the statement of changes in equity as reserves. That's all. Hakuna kitu ingine. Take out your past paper. Take out your past paper now. So actually, I'll send this. I'll send this. Everything I have said, I have summarized them somewhere. So I'll give you that. Don't you worry. I'll share with you. Let's open a question. November 2016. November 2016, question 2. November 2016, question 2. And I'm hoping you're having your past paper with you. Hoping all of us were there. November 2016. So you're told that the following trial balance was extracted from the book of Peak Limited as of that 1st October 2016. So we have land, we have building, brand, purchases, distribution expenses, admin expenses, loan interest paid, lease plant rental. Also, you have inventory, that's opening, account receivable, long-term investments. So you have long-term investment, those are available for sale. If they are short-term, those are financial assets at fair value. Then we have revenue, ordinary share capital, income from investment, retained earnings, 8% debentures, dividend paid, account payable, cash in hand, deferred tax, bank overdraft, then accumulated depreciation for both building and plant. Now let's go to the additional information. Number one, the 8% debenture was issued on 1st January 2016. Interest payable 6 months in arrears. We'll come to adjust that. Number two. Before I go to number two, I have seen someone asking a question. If the share price decreases, so we have no situation where the share price can go below the par value. The share price can go below the market value, but cannot go below the par value. If it goes below the par value, that one you need what we call reconstruction. That one means you have to petition for the court. So that means the share price cannot decrease beyond the par value, but can decrease below the market price. So let's go to additional information number two. Inventory was valued as 259.2 million as at that 1st October 2016. So that's the closing stock. Number three, on 1st November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which is payable in advance with effect from 1st November 2015, was 132 million. The fair value of the plant is 552 million, and the implicit interest rate is 10% per annum. Number four, plant is depreciated at the rate of 15% per annum using reducing balance method. That means based on the net book value. Depreciation expense is to be included under cost of sales in the income statement. However, you have told where to take that. Then number five, land and building were valued on 1st November 2015. Now 1st November, that means at the beginning of the year, at 600 million and 1050 million respectively. After revaluation, the building was estimated to have useful life of that 5 years with nil book value at the end of the economic lives. Then number six, the corporate tax for the year ended that 1st October 2016 was estimated to be 169.8. The deferred tax provision as at that 1st October 2016 was increased to 81.6. Required the income statement for Peak Limited in a format suitable for publication. That's published financial statement. Number B, statement of changes in equity. Number C, statement of financial position. So now we need to adjust now. We want to adjust every note. So we are doing that November 2016. We are doing question number 2. So let's start with additional information number 1. Number one, we are told that, if I may take you back again, that the 8% debenture was issued on 1st January 2016, 1st January, and the year ends on that 1st October. So that means the debenture have been in our company for 10 months. So this will get the interest. You take 8% of the debenture. Let's go to the balance sheet. We see how much was the debentures. The 8% debenture was 300. I'm hoping you are having your past paper with you. It's 300. So that you can get, remember 8% is per annum, times 300, you get the interest per year. But remember we issued it on 1st January 2016 and the year ends on October. So that means it's 10 months. So you multiply by 10, you divide by 12. If you do like that, you'll get 20. So this 20 is what you take to the income statement. Now, I want us to go back to the trial balance. There is somewhere we have given the interest, loan interest paid. Loan interest paid. Yeah, we have somewhere loan interest paid. And we have loan interest paid of 8. So that means you are supposed to pay 20, but during the year you paid 8. So that means sorry, we paid 12. Eh? Yeah, the interest paid was 12, sorry. The interest paid was 12. So that means you have balance of 8. So this one you take to the balance sheet as part of current liability. The 20, you take it to the income statement, the whole amount of 20. Eh? Remember, you account using the accrual basis. The 20, you take it to the income statement. Then we paid, of the 20, we only paid 12. So that means the 8 is you take to the balance sheet as part of current liability. Let's go to additional information number 2. Additional information number 2. Number 2, we are told that inventory was valued at 259 million as at that 1st October 2016. That's the closing stock. If you are given the closing stock and you are told the closing stock was 259.2, if you're given the closing stock, that means you are not given the cost of sales. If you're given the closing stock, you are not given the cost of sales. And how do we get the cost of sales? Cost of sale is opening stock, you add the purchases minus closing stock. That means, let's go back. The opening stock from the trial balance, inventory, 1st November 2015, it was 226.8. 226.8. Then you add the purchases, you go back to your past paper, The amount of purchases was 469.2. Then you deduct the closing stock, and you are given the closing stock was 259.2. If you compute that, you get the cost of sale as 436.8. That's what I can get. Let me repeat again. If you are given the closing stock and the additional information, you are given that one so that you can be able to determine the cost of sale. And the cost of sale is opening stock plus purchases minus the closing stock. Let's go to note number 3. Note number 3. You are told that, number 3, on 1st November 2015, that's at the beginning of the year, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st November 2015, was 132. So that means it's payable in advance. So this can either be paid in advance, like rent, or it can be paid in arrears. So you have to differentiate the two. When it's payable in advance, when it's payable in arrears. So in this case, it's payable in advance. So whenever you see leases, you prepare what you call amortization schedule. Amortization schedule. And in this case, you have to bear in your mind that in this case, you are paying them in advance. How do you account when you are paying leases in advance? Let's continue with the question. The fair value of the plant is 552 million and the implicit interest rate is 10% per annum. Let me give you 3 seconds. Go through that number 3 again, about leases. Good. Now let's continue. Now let's be here. Whenever you're paying your leases in arrears, now one thing you need to note, when you are preparing published financial statement, you only prepare the leases for only 2 years. So that means for the period, you only show just 2 years. Remember, you're told that the lease is for 5 years. You know about the 5, I'll show where to use the 5. But when you're preparing the financial statement, only prepare for 2 years. So you take the balance brought down. Then in this case, we are paying in advance. So that means you start with the payment. After you pay, now you can determine the balance due. To get the balance due, now you can determine the interest for the period. To determine the interest, now determine the principal, and now finally you can get the balance carried down. We are told that this plant has a fair value of 552. And the payment, which is payable in advance, it's 132. That means it's 552. You immediately pay, because you're paying in advance, 132. That means you'll have a balance of 420. That's what you'll take home. Then this 20 is what you'll pay the interest based on that. And the interest was 10%. If you take 10% of 420, it's 42. Now let's get the principal. How do we get the principal? How do we get the principal? Remember, you already paid them 132. If you paid them 132, they knew the interest was inside. Eh? So you take 132. First of all, they eliminate their interest. So it's 132. You raise the interest of 42. So that means the principal is 90. If you pay 90, that means the balance carried down. Remember, the balance was 552. You deduct the principal of 90. That means the balance carried down will be 462. You take 552, you raise the principal. Now the balance carried down becomes the opening balance. So it's 462. The payment does not change. So you pay them 132. That means 462, you minus 132. How much will you get? So in that case, you'll get 330. Then interest is 10% of 330. Take 10% of 330, which is 33. Now let's get the principal. You paid them 132. You eliminate the interest, which is inside. So that means you'll get principal is 99. 132 minus 33. To get the balance carried down, you take the balance carried down at the beginning of the year was 462. You deduct the principal. So it's 462 minus 99, and you get 363. Now, what do we take to the income statement? What do we take to the balance sheet? Kindly be here. To the income statement, just focus on the first year. What we take to the balance sheet, those are the liability, focus on the second year. I repeat again. To the income statement, you focus on the first year. This is the year we are working on it. I'd usually take two items to the income statement. Number one is the interest. And the interest you only take for year one. For year one, this year, we are supposed to pay an interest of 42. That's what you go to the income statement. Also, we have depreciation. Remember, the fair value was 552. It's an asset, it's a finance risk. 552, and it had economic life. Had economic life of 5 years. So that if you want to get the depreciation per annum, you'll take 552, you divide by 5. In that case, you'll get 110.4. That's what you get to the income statement. Let's go to the balance sheet. To the balance sheet, we have what you take to the non-current liability. Also have to take what you take to the current liability. Now, when you are paying in advance, this one usually take the balance due. And for the current liability, you take the payment. So remember, in this case, we are looking at liabilities. Liability is what you are supposed to pay, but you have not paid. So this is the year we are operating, year one. So year two is next year. So what you will pay next year, that becomes our current liability payment, of which every year we usually pay 132. But by the end of the second year, by the end of second year, which is the coming year, will not, by the end, you have a balance due of 330. That means 330 will take more than 1 year. That one becomes non-current liability. So I want to insist on something. If you are paying in advance, to the non-current liability, you take the balance due. To the current liability, you take the payment. If it was payable in arrears at the end, to the non-current liability, we usually take the balance carried down. And for the current liability, we usually take the principal. And remember, all of it, we are focusing to the balance sheet, we are looking at the second year, we are looking at this. Non-current liability, you take the balance due. And the balance due for the second year is 330. For the payment, 132. Payment, 132 for the second year. That because this lease we are paying them in advance. If we have been paying them in arrears, what changes to the non-current liability? You don't take the balance due. You could have taken the balance carried down, which is 363. And then for the current liability, you could have taken the principal. That's when we come to the when you're paying in arrears. Good. So now let's go to additional information number 4. Number four, you're told that plant is depreciated at a rate of 15% per annum using reducing balance method. And depreciation expense is to be included under cost of sale in the income statement. So now let's look at that depreciation. To be depreciated at the rate of 15% on a reducing balance. That means you go to the plant. The cost of the plant was 936. So you take 936. We're using the reducing balance. First of all, you deduct the depreciation, the accumulated depreciation, and we have the accumulated depreciation here. For the plant is 156 less 156. So you'll take 936. First of all, you raise the depreciation. So you get the net book value. Then you multiply by 15%. And by that, you'll get 117. And we have been told that depreciation should be taken to the cost of sale. Kwa hivyo hii ipeleke kwa cost of sale. Also, you had another depreciation here. You also take it to the cost of sales. Good. Let's go to number 5. Additional information number 5. Number 5, you are told that land and building were revalued on 1st November 2015. We have revaluation. We have land and we have building. Let's go to the trial balance. Go to the trial balance. The land, the cost was 400. Building, the cost was 1,200. But remember, building is a depreciable item. Let's go there down. There down, we have accumulated depreciation on building, which is 360. First of all, you raise 360. It's 1,200, you raise 360, and you come to see that it is 840. Land does not depreciate, it's 400, building, it's 1,200, you raise depreciation on 360, which is 840. Let's go back to the question. Number 5, land and building were revalued on 1st November 2015 at 600 and 1050 million respectively. So this one moves from 400, from 840, it was revalued to 600 and 1050 respectively. What we can observe that for the land from 400 to 600, we have a gain of 200, that's the revaluation gain of 200 million. For the building from 840 to 1050, we have a revaluation gain of 210. So that means we had a total revaluation gain of 410. Now, the question is, where do we take this revaluation gain? Do we take to other income or other comprehensive income? So kindly type that. I need to see your answers. Type, just type, I'll see them on my screen. Just type that. Other income or other comprehensive income. You can just write other income as OI, other comprehensive income, OCI. I can see Rini, OI, that's other income, other income. I can see from other comprehensive income, OI, So now, let me take you back. We say that fair value gain, that's what you take to other income. Then I said that revaluation changes for PPE and available for sale. Land and building, they are part of PPE. So that one you take it to other comprehensive income. So that means these 410, you take them to other comprehensive income. Don't you worry, I'll send you the material. You have to get them. I repeat again, if it was a fair value gain, that one you take to other income, kureju. But for revaluation changes for PPE, that's PPE and available for sale, you take them to other comprehensive income. Let's go back to note number 5. Still go back to note number 5. We are told that, including, land and building were revalued on 1st November 2015 at 600 and 1050 million respectively. After revaluation, the building was estimated to have useful life of 35 years with a nil book value at the end of economic lives. So that means you can get depreciation on the buildings. So it was revalued at the beginning of the year, and the value was from 840 to 1050. So you'll take 1050, and at that time, at the beginning of the year, it had a remaining useful life of 35 years. If you're given the economic life, you have to depreciate. So 1050 divided by 35, by that one you get that depreciation of that on building. And this one you take to cost of sale. Remember, you're told that all depreciation should be taken to the cost of sale. That's courtesy of note number 4. Now, 1 second, just screenshot that. I won't rub it. Screenshot that. Just screenshot that. Now let's go to note number 6. Note number 6. Note number 6. Note number 6. Note number 6, we are told that the tax expense, the corporate tax rate. So remember we said that tax expense is made up of 2 items. Tax expense is made up of 2 items. Number 1 is the current tax and the changes in deferred tax. So now let's go back there. We are told that the corporate tax for the year ended that 1st October 2016 was estimated at 169.8. So the current tax is 169.8. The deferred tax provision as at that 1st October 2016 was increased to 84.6. Now deferred tax, it was increased. Now let's go to the income statement. Let's go to the trial balance. Go and spot for me the here. Spot for me the deferred tax. From the trial balance, I can see the deferred tax was 75. It was 75. So it have moved from 75. It was increased to 84.6. It's an increase. So the current tax was 169.8. Then deferred tax has moved from 75 from the trial balance to 84.6. That means there is an increase by 9.6. An increase in deferred tax becomes an expense. So that means you have to pay more tax. You'll pay 179.4. Assuming it was a decrease, you could have deducted. So that means you'll pay less tax. So that's the tax expense. So now, after you're through with the workings, let's work out for cost of sales. From what we have grabbed, the cost of sales, we are after taking opening stock plus purchase minus closing stock, was 436.8. But remember, we had depreciations. We are told that depreciation should be taken to the cost of sales. You add, number 1, we had depreciation. We had depreciation for leased item, and the depreciation was 110.4. Also, there was a depreciation of plant, the one at 15% reducing balance, and we got 117 depreciation. And then also we had a depreciation for building with remaining economic life of 35 years. And with that, we have got 1030. That means our cost of sales. So that means the cost of sale in that case, it will be 694.2. Then let's adjust for PPE. What do we take to the balance? Remember PPE, we have said that we represented it as a single figure. For the PPE, we had land. Also, we had building. Also, we had plant. Then we had leased plant. This one is a finance. It's a long-term lease. You capitalize. We have the leased item. It's an asset. Now, land, if I take you back, remember the land. Here it is. The land was revalued from 400 to 600. So there was a gain of 200. So you take 600. That is it. Then building was revalued from 840 to 1050. So you take 1050, but remember it was depreciated during the year, and the depreciation for the land was 30. The depreciation was 30. So that means in that case, you if you take 1050 minus that, you'll get 1020. The plant, remember for the plant, it was using reducing balance. We had 396. We had accumulated depreciation of 156 from the 12 balance, and depreciation for the year was 117. So you'll take 936. You raise the accumulated depreciation, which was 156. And then we have depreciation for the year, which is 117. With that, you'll get 663. Then we had the list item. The list item, the fair value was 552, and depreciation, DOE, which was 117. It was 107. Sorry, it was I think 110, 110.4. In that case, you'll get it's 441.6. That means what you take to the PPE is 2724.6. Land, you take the revalued amount. Building, revalued amount, but you raise the depreciation of 30. Then for the plant, it was 396. It already had accumulated depreciation from the trial balance of 156. You raise 170. This is the depreciation for the year. You get that. Least item you capitalize, it's a finance lease because it's a long term. You take 552, you raise depreciation, you get that. Now, this is what you take to the balance sheet as one item. If you mess and you go and take land to the balance sheet, as we know you're preparing the balance sheet, you write land, building, plant, lease item. The examiner will just give you an X. That's not, you are not preparing published. Published should be summary. So just screenshot that before I prepare financial statement. And then I want to give you an opportunity just to ask some questions. You are free to ask questions. Just raise your hand. Go on.
Hello.
Yes, I can hear you. Poa.
Nasema. Hello.
I can hear you. Just ask the question. Isa.
Yes, niambie. Kuna vile nini bundle ziliisha. Bundle ziliniishia hapa hivi tisha, hapa kwa tax.
So what's your question?
Najaribu kuangalia vile hii 169.8 naona from 75 ikakuja to 84, but naona
yes,
hapa chini naona ni 179.4. What happened?
What has happened is this. You see, the current tax was 169.8. Then for the deferred tax, remember we said we look at the changes. From the trial balance was 75, it increased to 84. So that means it's an increase. Are you there? We say that increase in deferred tax is an expense. So it increased by 9.6. Come on, the expense, you add it. It was a decrease, you could have raised. So what I have done is take 169.8, that's the current tax. Then you add the increase in deferred tax of 9.6. That's how you get 179.4. Tuko sawa hapo?
Okay.
Yes.
Okay, so asante.
And you prepare yourself in advance with the bundles. Jaffe? Yeah, Jaffe, I can see. Yeah, I'll send everything. Don't worry. All the material, everything I'm showing you here, everything I'll send to you, soft copy. Yeah, after the class immediately. So don't worry. I'll send you everything. Yeah, you don't have to copy. I can see no other question. Jeff, any other question?
No question. I'm okay.
Okay, good.
Yeah, thank you.
So kindly after the class, kindly inbox me via WhatsApp. I share to you, then you share to the group. Yeah.
All right.
Another one? Abed?
Yes, how are you, Teacher Mark?
I'm fine, thank you.
Hello, Teacher Mark.
Now you can ask. Yeah, yeah, I can.
Thank you. No, my question is on the amortization schedule for leases.
Uh-huh.
Yeah, what is the idea between you using? Why are we using two years?
Okay, I've said this.
You got that, Teacher Mark?
Yeah, this is what I'm saying.
Yes.
When preparing the published financial
Yeah.
statement, the list was for 5 years, but
Yes.
we are only accounting for this year. So what you do, you only prepare for this year. For this year,
Yeah.
you only account what you take to the income statement. Now, for the second year, what you take to the balance sheet. Now,
Okay.
this is what I. Next year,
Okay.
you go to the next year. Now you account for year 2 and year 3. Are you getting? If you go to year 3, you account for year 3,
Yes.
year 4, just for the purpose of preparing financial statement. Yeah. So when
Yeah.
schedule to prepare when preparing amortization schedule for published financial statement, only prepare for 2 years.
Okay.
Not unless it's a specific question where
Yeah, I
it requires you to
get.
prepare the whole amortization schedule for the economic period.
Okay. I get it. Thank you.
Another question? Good. Now let's prepare. Sarah, if you are muted, it's okay. Ask.
Okay, my question was, when you were preparing the amortization schedule,
Amortization schedule, yeah.
we used the 2 years,
Yeah, we prepare for 2 years.
and there was a point that you said that there are some figures that you said
Can I look at your connection?
we are taking one. I was clarity on that.
Sorry? Can't hear you.
Oh, okay. I was asking.
Sorry, I think your audio is not that clear.
Okay, maybe I can ask some other time.
Okay. But for now, I can hear you. Just go on. Go on.
Okay, I was asking, after preparation of the amortization schedule, there are some figures that we took. Some we took for the first year, and then the other for the second year. It was not clear, so I didn't understand the concept.
Okay. Now let me repeat again. Let me kindly repeat again. Now, this is what I mean. This is the lease amortization schedule. Now, to the income statement, what you take to the income statement, that's the current year. That's the current year. So, to the income statement, you only take the interest for the year as well as depreciation for the year. That's what you create to the income statement for the first year. Remember, this year, this is the operating year. Now, the second year, this is the coming year. Now, the coming year, that one you not take it to the income statement. That one you take it to the balance sheet because of the liabilities. So that's the difference. So for the first year, you only take what you take to the income statement. To the second year, take it to the balance sheet. Good. So now let's continue. Yes, iPhone. Ask the question. Okay, good. Now let's continue then. Now let's present the financial statement. Let's start with the income statement. Let's start with the income statement. Now, what was the name of the company? This was Peak Limited. So it's Peak Limited. We prepare the statement of comprehensive income. Statement of comprehensive income for the year ended. When was the year ending? It was ending on that 1st October 2016. So our shillings are in millions. So we start with the revenue. Let's go back to the trial balance. How much was the revenue? Revenue. Can see the amount of revenue was 1670.4. Then you deduct the cost of sales. Now the cost of sale, you take the one which we had adjusted. The original cost of sale, we have added all the depreciations and we have gotten 694.2. So that means now we can get the gross profit. So if you take 1670.4 minus 694.2, you get 976.2. Then from the trial balance, I can see we had investment income. Yeah, investment income. And for investment income, I can see it was 27. I hope you have spotted it. Now let's list the expenses. Under the expenses, we have the admin expense, selling and distribution expenses, and then we have the finance cost. Admin expenses, that one had no adjustment. The way it is from the trial balance. Admin expenses, I can see it's 33. Make sure you get that. Then distribution expenses, it was 60. Distribution was 60. Now, finance cost. Now, let's be here. Finance cost. Now, finance cost entails the interest. Number one, we have the interest on the first one we did, the 10% loan note. The interest for the year was 20. Then you add, we had another interest. Remember, we have the amortization schedule. For the amortization schedule, we had the interest cost. If I take you back, this is what I mean. We had the interest for the first year of 42. So you add 42. So that means your finance cost will be 62. This 20 arises from the 8% debenture. Then you add 42, the interest from the amortization schedule. Now with that, you can get the profit before tax. You take this, you add that, you raise the 3. In that case, you'll get 848.2. Then you raise the tax expense. Now the tax expense, we had both the current tax and the deferred tax. Remember, we had already had an adjustment, taking the two. And in that case, we got 179.4. That means the profit after tax, you deduct profit before tax, you raise the tax, you'll get an amount of 668.8. I mean 0.6, sorry. Yeah, 0.8. After you get the profit after tax, now you can add other comprehensive income. To other comprehensive income, remember we had revaluation gain. We had a revaluation gain on both land and building, and we had a total revaluation gain of 410. Then you can get the total comprehensive income. And you get an amount of 1078.8. So you can screenshot that. Then we can prepare the statement of changes in equity. Good. So now let's continue. Part B of the question, what are the statement of changes in equity? Statement of changes in equity, how do we prepare that? So now let's look here at the board. number B. So peak limited, kindly remember to write the formula, the format, the heading, I mean. Statement of changes in equity for the year ended. The year was ending on that 1st October 2016. So now to the statement of changes in equity, you only look at the equity items. In this case, we had the ordinary share capital. I can see we didn't have share premium, but we have a retained earnings. And then we bring the revaluation reserve. Revaluation reserve. Those are the 4 items we have. So we start with the balance brought down. Balance brought down. So now for the balance brought down, to the ordinary share capital, let's go to the trial balance. From the trial balance, the ordinary share capital, I can see it's 900. Retained earnings, just go through your retained earnings. We have 717. Revaluation reserve, we didn't have any balance brought down. Then, now let's be here. We have profit after tax. Now, profit after tax will not affect ordinary share, will affect the retained earnings. That's why you take your profit. And remember, you don't take other comprehensive income. This is what I mean. We had profit after tax, then we added other comprehensive income. That's why we wrote revaluation. So in this case, you just bring profit after tax. Don't include other comprehensive incomes. And in this case, we had an amount of 668.8. Then you bring revaluation. Remember revaluation, you may end up with other comprehensive income. You bring it to the revaluation reserve, and we had an amount of 410. Then from the trial balance, I can see we paid dividend. Dividend paid. Remember, we usually pay dividend out of the retained earnings, from the profits. So that means, let's go to the trial balance and look for the amount of dividend paid. Dividend paid, I can see it was 90. You deduct that. Now we can have our balance carried down. So this is 900. 717, you add 68.8, then you minus the dividend of 90, you get 1295.8. And this one, it's 14. 1 minute to screenshot. We prepare the balance sheet now. Good. So now let's prepare the balance sheet. Prepare the balance sheet. So this is how we prepare the balance sheet. So part C, so it's peak limited. Statement of financial position as at, it was that 1st October 2016. Our shillings are in millions. So we start with the assets, particularly the non-current assets. The non-current asset, we had PPE. PPE, remember we had an adjustment for that. We had land, we had building, and we had the plant. Let me adjust, if we have gotten, it was 24.6. Then go back to the trial balance. We had long-term investment. Long-term investment. A long-term investment, that is part of non-current assets. From the trial balance, I can see it's 540. Now let's go to the current assets. And the current asset, note number 2, we had a free mark there. The inventory, the closing stock. Note number 2, it was 259.2. Then hatuwezi kosa receivable, account receivables. I can see it's an amount of 327.2. Also, I can see we have cash in hand. And for the cash in hand, we only have 2. So if you compute that, the total is 38.53. Now let's go to equity and liabilities. For the equity and liabilities, we had ordinary share capital. Then we have also seen we have the retained earnings or the retained profits, and also we had revaluation. This one we just copy paste from the statement of changes in equity, revaluation reserve. For the ordinary share capital, we have seen it was 900. Then 1295.8, and then revaluation, it's 14. Then now let's go to the non-current liability. Non-current liabilities. Number one, we had the deferred tax. Now, for the deferred tax, it was increased from 75 to 84.6. Now, to the balance sheet, you only take the balance at the end, not at the beginning. So in this case, we ignore the 75. You take, it was revalued to 84.6. Also, we had the 8% debentures, remember? The 8% debenture from the trial balance, it was 300. Then you need to bring lease obligation. From the amortization schedule, we said we have what we take to the balance sheet. We had non-current liability and we have the current liability. We have said that whenever you are paying in advance, for the non-current liability, you take the balance due, which was an amount of 330. Then let's go to the current liabilities. Under the current liabilities, here you have deferred tax as non-current. That means here we bring the current tax. It was just a provision. If you go back to note number 6, we are told that the corporate tax for the year end that 1st October 2016 was estimated at, it's just an estimate, 169.8. That means we have not yet paid, therefore becomes a current liability. Also, we have lease obligation and non-current. Also here we have lease obligation. We have what to take to the non-current liability, we take to the current liability. So in this case, whenever you're paying in advance, you take the payment, and the payment was 132. And then, do we have anything else? Yes. If we have receivable, you must be having payable. Account payables. How much was the account payables from the trial balance? From the trial balance, the amount of account payable is 202.4. 202.4. Then I can see we have bank overdraft. Bank overdraft. And the bank overdraft I can see is 20.4. Lastly, if I take you back, for the 8% debenture, we are supposed to pay an interest of 20. So we had debenture interest, of which we computed 8%, ikakuja 20. But from the trial balance, we can see we have what we paid, the interest paid. We had already paid 12. That means we had an obligation of 8. That one is a current liability. So by that you get that 8.53. Now, just a quick recap. Okay, this is for the purpose of doing your exams only. So we have some things that you can ignore, like PPE. If you just miss one thing, that means the whole figure will be wrong. But this one is just a free mark. Inventory is a free mark. Receivable free mark. Cash is a free mark. Ordinary share capital, no adjustment. This one you can get it wrong because number one, for you to get the retained profit correctly, that means you have to prepare your income statement well. Revaluation reserve, if you fail to interpret well, that one you can get wrong. Deferred tax is always a free mark because always to the balance sheet you take the balance carried down. Debenture, that one is a free mark. Lease obligation, that one is a nightmare. Current tax, that one you can get. Obligation, chanayo, and a trade payable. And bank overdraft. So here you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And the question was only giving you, I think it was 8 marks. It was 8 marks. So you already have the marks. So kindly, when you're dealing with the published financial statement, I know it's hard for most of the students to get them the workings correctly, but kindly make work smart. PPE, if you can be able, if you think your memory capacity is well enough, you can compute that. If you have 2 GB, chanayo. So a question before we go to another, the time is almost up, but I want to do another question, even if we do just the workings. Kazi kwenyu. You can screenshot this. 2 seconds to screenshot, and then I give a podium for you to ask the questions. No one. Good. Now let's try another question. Let's try another question. November 2015. November 2015, question 1. November 2015, question 1. November 2015, question 1. Can see there is a question. Jen?
Yes, I was asking.
Yeah, ask.
Suppose we are preparing the amortization schedule for an equipment that is in arrears. What we do in the statement of financial position, which figure would we put in the non-current asset and the current liability? No, non-current liability and current liability. Yeah.
I get you. So now, if you're paying in if you're paying in arrears,
yeah,
you still use the second year. Are you there?
Yes.
But now, the non-current liability, you take the balance carried down. That's the non-current liability. The balance carried down, not balance due, balance carried down.
Okay.
And then to the current liability, you take the principal of the second year, principal.
Okay, thank you.
Yeah, to the non-current liability, you take the balance carried down. To the current liability, you take the principal. That's when you are paying in arrears. That's just the difference.
Okay, thank you.
Hello, cha.
Yes, Isa uliza swali haraka.
1 minute. Let's end a loop, please. Loop, 1 minute.
You can go. November 2015. November 2015, question 1. Yeah. So, tuendelee before akuje. So 1 minute is over, so let's continue. Dora Limited, a quoted company dealing in household goods, has prepared the following trial balance as at that 1st December 2014. So we have the revenue, we have the loan interest paid, purchases, distribution cost, admin expenses, interim dividend paid, inventory, trade receivable and trade payable. We have cash and cash equivalents, ordinary share premium, general reserves, retained earnings, 4% loan payable. We have loan and land and buildings, both at cost and accumulated depreciation. Plant and equipment at cost and accumulated depreciation. We have investment property. We have rental income. We have proceeds from sale of equipment. Additional information. Number 1, closing inventory as at that 1st December 2014 amounted to 388 at cost. However, shortly after the year end, some inventory with a cost of 15 million was sold for 8 million. Number 2, land and building were revalued on 1st January 2014, that's at the beginning of the year, to 800 million, including land, 100 million. The building have a remaining useful life of 40 years. Then number 3, the income tax liability for the year was estimated at 20 million, that's the current tax. Deferred tax was to be provided at 7 million. Then number 4, during the year, the company sold some equipment which had cost, during the year, the company sold equipment, which had cost 15 million with an accumulated depreciation as at 1st January 2014 of 3 million. An item of plant was also estimated to be impaired by 4 million during the year. Then number 5, depreciation rates as per the company policies as follows. So we have the building, that's over useful life period. Then we have plant and equipment, 20% on reducing balance. The company accounting policies to charge full year depreciation in the year of asset purchase and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sale and land and building to admin expenses. Dollar Limited values investment property at fair value. The fair value of investment property as at that 1st December 2014 was 586 million. Number 7, during the year, the company made a 1-for-3 bonus issue, capitalizing its general reserve. This transaction has not been accounted for. Then from there, we just prepare the financial statement, the income statement, statement of changes in equity, and statement of financial position. So now let's go back to the workings. Go to the workings. We start with note number 1. Note number 1. Now, note number 1, we are told that closing inventory as at that 1st December 2014 amounted to 388. That's the closing stock is 388. However, shortly after the year end, some inventory with cost of 15 million was sold for 8. We had inventory which was costing 15, but was only sold at 8. That means there was loss on inventory and loss of 7. A loss of 7. So now this is what we call the loss on inventory. Now the loss in inventory, how do you account for it? Number 1, what do you debit? What do you credit? You add it to cost of sales. You less it from the closing stock. Remember, it's a loss of 7. Kwa hivyo that loss, you take it, go and add it as part of cost of sales, and then you deduct it from the closing stock. Or you can do this. Closing stock, it was 388. You deduct the loss. Remember, you have said that you credit the closing stock. You less 7. That means the adjusted closing stock should be 381. So remember, I said that whenever you're given the closing stock and the additional information, you are required to get the cost of sales. And how do we get cost of sale? Cost of sale is opening stock plus purchases minus closing stock. How much was the opening stock? From the trial balance, I can see the opening stock. 1st January 2014 was 444. So you take 444. You add the purchases. The purchases I can see was 1669. 1669. You raise the closing stock. So in this case, don't deduct this. Just deduct 381. So, and if you do that, you come to get it will be 1732. Let me clarify something. We had loss on investment, loss on inventory. We have said you added to cost of sale. Don't add it here because already we have adjusted the closing stock. Or you can simply do this. You just take opening stock, which is 444, plus the purchases 1669 minus closing stock, the way it was 388. before adjustment. Now what you get, that's when utakuja uongeze. Tumesema you add back cost of sale. Ukuje uongeze hapo that amount of 7. You'll still get this answer. Now let's go to note number 2. Note number 2. Note number 2. Note number 2. We are told that. We are told that land and building were revalued on first. Kwa hivyo kuna revaluation. We have land and we have buildings. And remember, they were revalued at the beginning of the year. So let's go to the trial balance. From the trial balance, we can see land and building at cost. The land is 60 million, but the total is 380. So if you want to get the building, it's just 380, you raise the 60. That means this one is supposed to be 320. This should be 320. I repeat again, the land and building you are given the total is 380. But you are told that land it's 60. That means the building is just 380, you minus 60. So that means it's 320. But remember, building is a depreciable item. From the trial balance, we can see accumulated depreciation, land and building, which was 64. So that means if you take 320 minus 64, 320 minus 64, you get 256. You'll get 256. Get 256. So land is 60. This one is 256. Then we go back there. Land and building were divided on 1st January 2014 to 800 million, including land 100. Land it's 100. That means the building. Remember the total was 800. That means this one it's 700. That's when you are getting a total of 800. So that means here we have a gain. We have a gain from 60 to 100. We have a gain of 40, and the other one we have a gain of from 256 to 700. That's 444. That means we have a total gain of 484. Now the question is, where do we present 484? Is it as part of other income or other comprehensive income? So remember we said that revaluation of PPE, we take it to the part of other comprehensive income. Other comprehensive income. Good. Then, still at note number 2, the building had remaining useful life of 40 years. That means we need to get the depreciation for building. It was revalued from 256 to 700. That means you take the revalued amount 700. It had remaining useful life of 40 years. So it's 700, you divide by 40, and you'll get 17.5. Good. Let's go to note number 3. Note number 3. The income tax liability. So if you see income tax liability, we need to get tax expense. Remember I said that the tax expense is made up of both the current tax and the deferred tax. Now let's go back to note number 3. The income tax liability for the year was estimated at 20, so that the current tax. Deferred tax was to be provided at 7. You add 7. Let me clarify on this. Can you go back to the trial balance? From the trial balance, you can note that we have no deferred tax balances. That means they had never provided for deferred tax. But at the end of the year, so that means from the trial balance, it has increased from 0 because you don't have deferred tax. But this year they have provided 7. So that means there is an increase by 7. So if it's an increase, that one becomes an expense. So that means the tax expense will be 27. Let's go to note number 4. Note number 4. Note number 4, you are told that during the year, the company sold some equipment which had cost 15 million with an accumulated depreciation as 1st January of 3. Hapa kuna disposal. This item, it had costed 15 and had accumulated depreciation of 3. That means at the date of disposal, the net book value was 12. Then we want to determine if we dispose at a gain or loss. Now let's go back to the trial balance. The last item from the trial balance here, this is what I mean. We had proceed from sale of equipment, proceeds, and we can see it's 7. So that means 15 minus 3, you get the net book value. The real value was 12, but the proceeds or what we got, we only got 7. So that means we had a disposal loss. Disposal loss of 5. And where do we take 5? Remember I said that expenses, it's either cost of sale, admin expenses, distribution, or finance. So disposal gain, this one you can take it to the cost of sale. Good. Let's go back to note number 4. I told that during the year, the company sold some equipment which had cost 15 million with accumulated depreciation as at 1st January 2014 of 3 million. An item of plant with was also estimated to be impaired by 4 during the year. Impairment. Now, impairment is also another expense. So we have an impairment of plant of 4. So this one is still an expense. We'll come to know where to take that. Then, number 5. Depreciation rate as per the company policies as follows. Building over the useful life period, of which we already have it. Depreciation for the building was 17.5. Equipment, 20% reducing balance. So now let's get depreciation on plant and equipment. We are told it's 20% on reducing balance. So kindly, I want us to be here. Let's go to the plant and equipment from the trial balance. Plant and equipment. Remember, you're using reducing balance. So the cost is 258. But remember, we sold an item which had cost 15. You eliminate from this the cost, you eliminate the item we sold, 15. Minus, I'm taking the cost minus depreciation. How much was depreciation from the trial balance? Accumulated depreciation was 126. But of this 126, we disposed an item of which had an accumulated depreciation of 3. We eliminate that 3. That means we will be working with 20%. It's cost minus depreciation. So 258, first of all, you eliminate the 15, the cost we disposed. By that, how much will you be getting? You'll get 243 minus this depreciation, 126, we eliminate 3, the one we disposed. So that means we'll be remaining with 123. So that means it's 20% of that, of which you'll get 24. Because we are told that, let's go back to note number 5. Note number 5. Plant and equipment is 20% reducing balance. The company accounting policy is to charge full year depreciation in the year of asset purchase and none in the year of disposal. The company treats depreciation on plant and equipment as cost of sales. That means plant and equipment, this one 24, you take it to the cost of sales. And land and building as admin expenses. That means depreciation of building, you utapeleka kwa admin expenses. But for the on a PPE, for the plant and equipment, you take it as part of cost of sale. That means also this one impairment you take to the cost of sales. Good. Let's go to note number 6. Note number 6. Dora Limited investment. Dora Limited values investment property at fair value. So for investment property there. Then you are told that the fair value of the investment property as at that 1st December 2014, that's at the end of the year, was 586. Now, investment property from the trial balance, if you go to the trial balance, that's that item from the last. Investment property at the beginning was 548. But additional information number 6, we are told that at the end of the year, it was revalued. It was revalued to 586. 586. So that means we have a gain of 38. we have a revaluation gain of 38. Now, my question is, where do we take it? Is that part of other income or other comprehensive income? So kindly post your answers there. You can text your answer. I'm looking at your answers. We have investment in property. It has gained by 38. So where do we take this one? Is it other income or other comprehensive income? I can see other income, other income, other income, other income. Other income. Yeah, correct. It's part of other income. Why? Let's go back to note number 6 again. Number 6 again, we are told that Dollar Limited values investment property at fair value. Remember, you said that fair value changes. That's what you take to other income, fair value. Yeah, so that one you take to other income. But this one on land and building, that one you take to other comprehensive income. You can take screenshot on that as I rub. Just take screenshot. Now let's go to number 7. Additional information number 7. Number 7. Now, note number 7, we are told that during the year, the company made a 1-for-3 bonus issue. So in this case, we have bonus issue. Now, bonus issue, this is where the company grants the shares to its shareholders for free. That's what they call bonus issue. That means the shareholder will have to pay nothing in return. So that means you have to increase the ordinary share capital. But where do you get this amount to take to the ordinary share capital? You take it from reserve. Let's read that. During the year, the company made a 1-for-3. That means if you have 3 ordinary share, you get 1 bonus. That's what we call 1-for-3. So now let's go back to the trial balance. Ordinary share capital. I want to know the number of shares the company had. For every 3, you get 1. What about? Let's go back to the trial balance. Ordinary share capital. For the ordinary share capital, each at 10, it's 100. But each at 10, you divide by 10 to get the number of shares. So that means we have 10 million. For every 3 shares, you get 1. What about 10? So that means it's 10 divided by 3. In short, it's just 3.3. And each share, the par value is 10. So that means we have that 3. How do we account for this, that 3? What I know, or what you know, is that we'll have to add to the ordinary share capital. But where do we deduct this? Let's go back. During the year, the company made a 1-for-3 bonus issue, capitalizing its general reserve. That means from the general, this amount, walitoa from the general reserve, wakaongeza kwa ordinary share capital. That means you add to the ordinary share capital, you deduct from the general reserve. The transaction has not been accounted for. Good. Now we are through with the additional information. Now let's adjust something. Let's go to expenses. At the expenses, we had cost of sale, and also we had admin expenses. The two, they need some adjustment. The cost of sale from what we had computed earlier, the cost of sale was 17, that too. Admin expenses from the trial balance, admin expenses is 345. Then we need to adjust for depreciation. You add. Remember, note number 5, we are told that the company depreciation for plant and equipment, you take it to the cost of sales. And we had a depreciation of 24. Then there was an impairment. Remember, we had an impairment loss, still at note number 5 of 4. Then we sold an item of plant at a loss. So that loss on disposal, you take it to the cost of sale, 5. I repeat again, 17, that 2 is the balance brought down. Depreciation on plant and equipment on a reducing balance. Impairment of plant, loss on disposal of plant. Admin is 345. We were told that depreciation on land and building, it should be taken to admin expenses. I remember depreciation on land and building, we had an amount of 17.5. So that means this one will get 176.5 and this one will get 362.5. Then let's work on PPE. Remember, you said that PPE should be taken as one figure. Number one, we have land. We also had building. Then we had plant and equipment. Land was revalued. The land was revalued. And it was revalued from how much? How much was land? Land, remember, it was 800. Eh? Land was revalued, or we can just combine the two. Eh? It's easier to combine the two. Okay, or you can just do this. Eh? The land was revalued from, that was not courtesy of note to 100. That is courtesy of note number 2. Land and building were revalued on 1st January 2014 to 800 million, including land of 100. Eh? So that means the building, this was 700, minus, it can depreciate by 17.5. So you have 700 minus 17.5. That means you remain with 682.5. Then let's go to plant and equipment. Plant and equipment. Now, plant and equipment, this is what you do. From the 12 balance, we had 258 with an accumulated depreciation of 126. How much do you get? Is 256 minus 126. You get the net book value, which is 130. I mean 132. Then we disposed an item. It had costed 15, but had already accumulated depreciation of 3. That means at the date of disposal, that's 12. So that means it's 132 minus 12. So the remaining plant and equipment is 120. Then it can depreciate. Now you have depreciation for the year, which was 24, and then it was impaired by 4. It was impaired by 4. So you take 120, you raise depreciation of 24, you raise also impairment of 4, and you get 92. So with that, the total you get, that is 874.5. I'm sure you have some question. What's the difference between depreciation and impairment? Eh? Now, depreciation, I know you know what is depreciation. Now, impairment, this is what you mean by impairment. Eh? Assuming you have a car, which is worth 1 million. Then by the end of the year, it has depreciated by 200. That means the net book value is 800. So this is the cost, this is the depreciation, this is the net book value. Assuming now you want to sell this now, you want to sell because you have some financial difficulties. Eh? But the highest bidder, the maximum he can give you, it's 700. The maximum he can give you is 700. But you know the real value is 800. So that means you will have a loss of 100. Now this 100 is what we call impairment loss. That's the difference between a depreciation and impairment. So you can screenshot that. Now, I don't think I'll prepare statement, the statement of financial position. Now you have all the workings. With the workings, so what you are remaining with is just the solutions. This or Hazel. So I'll send you all the material. Number one, you have the workings. So the working is the most important. After you get the workings, now presentation becomes easier. So now I'm sending you, I'll be sending you right away the solutions. Also, there is an assignment. Also, there is another illustration. So actually in this handout I'll send, I have 3 good computed solutions with well-explained workings. So kindly make sure you go the first page, you read through what we discussed before we started, and then you go through those illustrations we have done. Then after that, you can do some assignment. Then you can send to me. I can mark, I can help. Or unless we have a question. Any question? Any question? Any question? Yes, go on. If you see you are unmuted, so kindly just ask the question. Alice or Abed? Let's start.
Abed, huh?
Yeah, Abed.
I think mine is away from that. Just to inquire when we'll be having our QA class.
Our QA is